So why don't we start with the State of the Union, Terry, because by this point I think everybody here has digested the president's remarks. And we know that he was trying to strike a balance between responsibility and the debt that he still feels he has to the American people to create jobs and to encourage growth. Do you think he struck the right balance?
Well, I think it was pretty much a cover the waterfront with the exception of the entitlements. I mean, it was a cover the waterfront presentation. And I think it was very important for the administration to recognize all the components, and the various issues that way. If you were looking for a vision from A to B and what's B, on that wasn't the speech. It was all the things in between A and B that need to be addressed on that one. So you heard a lot about business environment, that we've got to make an environment conducive to businesses doing investment. So corporate tax rates, tax reform overall, that we've got to make sure that we're competitive by getting skill gaps closed and all of those kind of things. Those are all very important messages. The education thing was very important. As we're sort of departing the last 2.5 decades of the information society and now entering the knowledge economy, we aren't prepared. We have a skills gap. We can talk about skill gaps elsewhere, but we have our own skills gap within the United States. And if we don't get this education agenda right, we're going to have enormous problems with our future workforces on that. Also, I was very glad to see the trade agenda being pushed. I would like to see a more enhanced agenda of where we're going. When we talk about Korea, which is the most comprehensive and most meaningful trade agreement we've ever done, absent NAFTA, I think, we negotiated, Colombia a long time ago. Panama, it's a very small one. It's 1.2 million. So that's fine. And then we keep talking about the Trans-Pacific Partnership. Well, let's get moving on that agenda. I think another one that's very important is India. Now we've made wonderful steps from March 2006 with President Bush to President Obama this past year. We need to get another step. Now, I don't think a free trade agreement is doable right now. I mean, it takes a lot to get into a very comprehensive trade agreement. But I do think, we could do a bilateral investment treaty. I think we could do some sort of economic partnership agreement, something that would be sort of FTA light on that one. But it'd be a very positive step to go. So a lot of stuff in it. And I think a lot of people are saying, well, great. Now the question is, are we going to get it done?
Are you one of those American CEOs who has been reluctant to make investments because you don't feel like there's enough clarity on some of those key issues you mentioned, like corporate taxes?
Well, we got to go back a little bit. I mean, from 2008 into 2009, that was probably one of the roughest periods that we saw.
Oh, sure. I'm thinking the last 6 months.
Yeah. No, we're making investments and we're doing transactions. We balance things out, in terms of our free cash flow, and our free cash flow is pretty high. We just increased the dividend 6.4% last week, and we like that. We're also going to be back in the market with about 150 to 160 million of share repurchase, and we're also doing transactions, and we have organic growth projects as well. So, again, it's right across the board. We're making those investments. You need to be.
Okay, but returning capital to shareholders in the form of a dividend is something that maybe the White House would say, isn't a productive way to create jobs. Maybe there's a trickle-down effect. The U.S. consumer needs some money, but if we're to get jobs created in America, the way to do it is for companies to invest that capital back into their own businesses.
Well, I think it's a balance on this one. And if you get into portfolio theories and all of that, we've increased the dividend every year since 1974. And it is a key component of total shareholder return. Making sure that, shareholders get an investment return while they're waiting for the appreciation and like is very important. It's not one or the other on that part. You need the balance.
How about hiring? How many people do you think you'll hire in the United States this year?
I think it'll be very modest.
Really?
On that one, we went through some restructurings in 2000, the end of 2007 and 2008 on that one, but not at severe levels on that one. So we're going to be very cautious as we go. At this point, I would say that it's going to be in the 3-4% level.
3 to 4%. What would it take you to want to build a bigger business effectively in the U.S.? What would it take for you to want to hire more people and invest the money in human capital?
Well, in terms of opportunities and, organic growth projects and the like that you would do that, we have some very big ones in the digital education side, and there's where we have brought new people in. But for us, in terms of the existing business at this point, we are starting to see some of the need for that, especially at Standard & Poor's, for example. We're seeing a very, aggressive, corporates, munis, high yield, CLOs kind of market at this point. Not so much on the structured finance, although there's some on the commercial mortgage-backed area and asset-backed. But on the corporate side, very strong.
So, okay, well that brings us to a good point. Let's talk a bit about Standard & Poor's, and let's talk about the demand for credit ratings. You see a meaningful increase, as you say, in the demand on the corporate side. Do you anticipate that we'll see more come back on the structured side?
Yes, I do. I think it's going to take a little time. And I think we'll see on the commercial mortgage-backed area some activity. We already are seeing some activity, and I think we'll see more of that, Eric. On the residential mortgage-backed area, I think that's going to be a little bit slower.
But there's so much talk that we need to see that securitization market return if, Fannie and Freddie are ever to be weaned off the U.S. government.
Yeah, that's correct. And I think that we all have to see as we get into the new session of Congress stateside, what the investigation or what the thinking is going to be on Fannie and Freddie and what kind of reform is going to be looked at.
Is there anything that the rating companies like Standard & Poor's and Moody's can do to kickstart that market? Is there anything that you can do to push it forward?
No, not from the standpoint of creating demand. I mean, we can write about it. We can, we can communicate what we think ought to be happening and the like. But no, the market participants have to be the ones that lead that, and we'll be the ones to analyze it.
As the CEO, clearly you need to be certain that the ratings at S&P are realistic and reliable. At this point, can you say that you confidently are?
As confident as one can get. I mean, the problem that we had, as you well know, is in the structured finance area, and in particular in the residential mortgage-backed area. The problem was, our predictions of the housing recession. We thought it was going to be more like more regional, that it was going to be more 18 months in duration. And as we know, it's still not quite over. And peak to trough home prices, we thought at the worst could decline 15%, and it's more like 40. You put those into the models, and
everything changes.
Everything changes on that. Corporates, sovereigns, the other areas, municipals, they are all solid on that one. Now, again, Eric, with a credit rating, it's not just a credit rating, and what is it on that part? It's all the analysis and all the analytics that goes into creating it. When we put out a rating, that's the conclusion. We put out all the information for the investor. So you'll see all our assumptions, you'll see all our criteria, you'll see how a ratings committee debated it, and you can then make your own judgment as an investor whether or not you agree or disagree with that. But we put forward a position, so it's more like a starting point, and it culminates into a credit rating.
Yes, but and you have a point, certainly, and people are free to do their own credit analysis, but at the end of the day, just like an equity investor is going to focus on the analyst's rating, buy, sell, or hold, the credit investor is going to focus on the credit rating.
Right.
Let's talk about a credit rating. Portugal, for example, right? Currently rated A- by Standard & Poor's. Now, your own language defines a single A rating as one that reflects an issuer's strong capacity to meet financial commitments. you talk to anybody here at the World Economic Forum, and they don't feel that Portugal has a strong capacity to meet its financial commitments. So how do we reconcile that?
Okay, you also have within the European Union a commitment that is going to back up and support some of these countries. It's just like a government guarantee in the United States, without naming names.
But shouldn't it be then AAA? I mean, if the EU is going to be there for Portugal, come hell or high water, why shouldn't it get Germany's credit rating?
Right. I better not get into, my interpretation of what it is. We've got the folks to do that. But all I can say is a lot of things go into that, and the transparency, making sure that investors have what that, definition is what's most important. But if you have guarantees, it wouldn't necessarily be AAA. There might be other factors, whether or not they apply for it, or whether they would clear for it, and all that. So whatever the ratings committee determines, is what that is, and that gets published.
Okay, but as the CEO, your principal concern when it comes to rating ultimately is credibility, because your business depends on credibility.
Trust,
not just
credibility,
absolutely.
reputational risk, and
so
quality.
On that front, though, what do you say to yourself when you look at the ratings that your analysts produce and the market says something completely different, right? Portugal there's a CDS spread right now on 5-year Portuguese debt of about 420, right? And you look at countries like Croatia, for example, and Iceland, which have lower credit ratings, which is to say worse, but also lower credit spreads. The market is effectively saying, that the rating is wrong.
Well, at any given time,
that's a credibility issue. I'm not asking you to tell me whether Portugal should be lower rated.
At any given time, you might have some discrepancies, but for the most part, the correlation between bond yields and the credit rating are very solid on that one. But at any given point in time, again, depending upon what influence could be on that, and with the EU, backstop, plan, that has an effect to it. But it's all in the analysis.
You're confident, though. I mean, the confidence that you're reflecting, I take it, is one in the EU's willingness and ultimately determination to keep the Eurozone intact and to keep the Euro itself, from losing investor confidence.
Exactly. I think that I can't predict or make opinions about where I think or what I think should happen and all of those kind of things. Again, I think it's in the best interest that we have the most factual information and analysis and put that out there, and people can judge. Now, again, we have to make sure two things. One, that the correlation between bond yields and the credit rating are well correlated. And the second one is that we've got to make sure that the compliance and surveillance system is ironclad. They're very separate from the analytical side, and the rigor in terms of getting after the quality of the criteria and the risk factors, and the compliance is very, very important. Those are all separate functions on that one. And one of the things that I wanted to make sure of is that we doubled our investment in that to make sure that it's state-of-the-art and ironclad.
Okay. But what you're talking about is the relationship between credit ratings and bond yields. There are a lot of people who would tell you today that the credit default swap market is a much more accurate reflection of what investors perceive any borrower's risk to be than bond yields.
Well, I think any good investor is going to take a look at a lot of different things. And at any given time and any aspect of the market, you could have a discrepancy. The surveillance system is watching that as well. And it goes back to the ratings committee, and the rating committee continues to evaluate that.
Here's another issue that's come up, and I suspect it's one that you've considered. How do ratings contemplate liquidity, which is to say, a sovereign rating, and for the most part, a corporate credit rating is concerned with solvency, right? Can you pay your bills?
Right.
But what we found out during the financial crisis is the liquidity can be as much of a risk to a borrower as solvency. You may, in fact, on paper be fully solvent and yet unable to tap credit markets, and as such, illiquid and in a position of default.
Correct.
credit ratings today don't reflect liquidity concerns yet.
Well, I think that, again, in terms of the surveillance aspect of it, is that they're looking at every aspect of it. It goes back to the ratings committee, and it's their judgment as to whether
But credit rating analysts have, I mean, I've spoken to your competitors too. Credit rating analysts are loath to cross that bridge. Yet, as we found out, it may be the single most important link in the credit markets. I mean, do you feel as though perhaps that's something that ought to be blended more into credit analysis?
Well, let me just say that I promise you they are looking at every aspect of that, just as you are looking at every aspect of that. And if they believe that's necessary, they will.
Let me talk to you about the business of credit ratings. Clearly, right, it's a good one. Otherwise, there wouldn't be a bunch of people wanting to compete with you. Does it pose a legitimate threat to your business?
No, I think that...
And I'm not talking about the established competitors. I'm talking about the new would-be competitors, the new little boutique credit rating operations that people are beginning to form.
Well, you got to remember now, Eric, we have 1,300 analysts, around the world, dealing with all aspects of the credit market. If you want to do a slice of this or a slice of that, that's fine. But overall, it is a big undertaking, and so I think competition's good. But I like the position that we have and where we are. Now, I thought where you might be going to, Eric, is going to be the credit supply. We're seeing a lot of different numbers coming out of the World Economic Forum. They're talking about a number in north of 100 trillion in worldwide debt over the next 10 years. We are estimating...
Maybe there's more than enough to go around for everyone.
Yeah. Well, we're looking at somewhere around 70 trillion worldwide, both in the public and the private sector, either raising or refinancing, over the next 4 years out to 2015. This is enormous amounts, and given all of the infrastructure investment, given all the other appetites for growth, this is a lot of money.
So, is that to say that you think maybe S&P's credit rating business could end up in the not too distant future being bigger than it was during the pre-crisis credit bubble?
Absolutely.
How many years from now?
I think that as we start to see, parts of the market recover, and the corporate part that we talked about is doing so well, as there's going to be more demand on the refinancing side, and I think this is going to be a big opportunity for us. And one that frankly we're very excited about. One of the things that we look to was the IMF, who did their own study, as well as the SEC, and both of them came out and said, given things that happened and all of that, we need these kinds of benchmarks in the marketplace, in order for investors to be able to discriminate, between investments. So, we were gratified by that, but also in our own way, when we start talking about, the development of credit markets, banks are deleveraging and aren't lending at the same kind of rates on that. What you're seeing cropping up around the world are these local bond markets. Why are we doing so exceptionally well, for example, in India? And I think, well,
people need money.
That local bond market there is really expanding. Saudi Arabia developed a local bond market. Indonesia, Malaysia, South Africa. And so what we're doing in terms of our global pursuit is developing those local partnerships and local capabilities in those markets where there is a local bond market.
I have two more questions before I let you go. I'm sure you've got things to do. The one is this: does the issuer pays model ever go away?
From our standpoint, no, because, and here's why. I mean, once again, if transparency is what you're after, we disseminate all of the information on that rating worldwide free. On that one. If you go to that's with issuer pay. If you go to investor pay, then you enter into these confidential agreements and you don't have the transparency. I hope I didn't misspeak on that. The issuer pay model is where you get the transparency, and if that's the part of the equation you're trying to solve for, issuer pay will be the model.
All right, and the final question is this: you look at the debt that your company rates and other competitors of yours rate. People have concerns about two categories of debt in particular right now: sovereign debt and municipal debt and state debt in the United States. Which to you presents a bigger risk?
Well, I think that, really the one that we need to watch very carefully, is on the municipal side. But our track record over the last 25 years is extremely good. We've rated 17,500 issuers, and the default rate is 2.5 on average per year. Still, what we're talking about and some of the things that we're dealing with in terms of criteria is making sure that we've got everything included. There's a lot of things going on between pension plans and lots of other ins and outs, and one of the things that we must make sure of, that it's a comprehensive, inclusive analysis that includes all of that. And in the United States right now, our municipal entities are in dire shape.
They certainly are in dire shape. It actually raises one last question, and it applies to munis equally as it applies to sovereigns, which is this. Given what you just said, it made me think of Illinois, it made me think of California, and given what we talked about concerning Portugal a few minutes ago, would it not make sense if you're contemplating an implicit backing, whether it's potential bailout by the U.S. government or a bailout by the EU, would it not make sense to have two ratings? One that actually rates the financial strength of the issuer itself, and then another that incorporates the potential lifeline that one may have, because that's really, we got down to it. That is the area of confusion and debate. Okay.
When you get into that kind of methodology, I'll leave that, to them. But and both are going to be addressed in terms of the analysis. It'll be incorporated into a single rating. But if there was a feeling that there was a component that needed to be brought out, they would.
And give it a separate rating?
If they thought that's what it needed, they would do that.
But does the CEO think that that's what they need to do?
Well, I don't go into that with them. Again, one of the most important things, whether it be any of our index funds, whether it be on the journalistic side with publications or things, with an editor-in-chief, if I think there's something not right or whatever, I can fire the editor-in-chief. But I don't tell them what to put between the covers on that one. Ratings are the same thing. People have to know that that they're independent, that you've got professionals that are accountable and that are putting out the transparent information on what's going on. I make sure that the process is followed on that. And if I don't think the process is being followed, and I think we have problems, we'll deal with it.
All right, Terry. Thanks so very much for taking the questions. Pleasure talking to you.
Thank you, Erik.
Have a great time here in Davos.
Thanks.